are flights from Dubai to Mumbai bringing refined gold to sell and silver. Gold's given up like 22% of its spike. Silver's given up 50% of its spike. Silver market's relatively tight. Okay, I want to sell my silver. I can now sell it at a profit, but I look at the world, I look at the state of the world, and I look at the rate of increase in silver prices, and I think I'm going to wait. We think that the gold price probably will stay above $3,800, $4,000 in the near term, and that the price will probably consolidate with a slight upward bias over the next year. We've never seen net investment demand of physical gold as high as it was last year. Then you get into the final 4 months, you've got a very dangerous electoral situation in the United States that's going to get nastier, and that's going to cause more people to want to buy gold.
Goldman Sachs or JPMorgan are projecting higher gold prices, $5,400, on the back of stronger central bank demand or perhaps ongoing Iran conflict. And all these are assuming, Jeff, I'm looking at the gold spot price on my screen versus the DXY. So I've asked a lot of people why gold fell on the day the Iranian regime was struck by the U.S. and Israeli forces on the 28th of February. And you would think, logically, if gold is a safe haven, it should go up. But as time has proven over and over again, the world tends to flock to the dollar during times of extreme duress, which is what happened on the 28th of February. Right. The dollar, which is the blue line here, spiked up and gold went down. What's interesting to me is that the dollar continued to hover around the same range. It's come down somewhat, this downward trend in the DXY, and gold has not inversely responded to the dollar coming down somewhat, meaning gold hasn't gone up. And in fact, the selling pressure on gold has intensified. So maybe comment, broadly speaking, on the relationship between the dollar and gold and why it is that sometimes, not always, sometimes flows into one asset leads to outflows into the other. Yeah.
Gold and the dollar are the two safest haven assets that people have. So when things when risks or uncertainties or anxieties rise, sometimes people pour into the dollar, sometimes they pour into gold, sometimes they pour into both. Now, I would take exception with some of the things that you were saying, and maybe not exceptions, but I would add nuances.
Markets didn't panic into gold when missiles flew. They rushed into the dollar instead. And that's the uncomfortable truth. As Jeffery Christian points out here, safe haven behavior isn't fixed. It rotates based on liquidity, not fear alone. February 28th exposed that when stress spikes, institutions prefer the dollar's depth over gold's narrative, especially with global funding tied to USD. But the real red flag is gold failing to rebound even as the DXY softened. That signals underlying selling pressure, not just currency mechanics. Next, Jeffery Christian discusses what actually drove that deeper weakness in gold prices.
Sure.
If you look at your chart, the dollar had come off in late January as gold reached $5,500, $5,600 an ounce.
That's right.
The dollar rose through February and into March, right? So what you saw, yes, you saw a spike up when the United States and Israel attacked Iran, but that was a continuation of a trend that had gone on for a month. On the gold side, yeah, the gold price fell, but it fell earlier. And then it recovered, as you said, and then it was sort of trending lower. And there were several factors. I would cite 4 factors behind the gold price. And I would point out that the gold price, while it did trend down after the initial attack, it was a couple weeks later, it was last week, when the price really fell sharply. And I'll get back to that. But the reality is that, okay, gold prices plunged from $5,500 to $4,100 on Monday. It's a 20 some odd % decline, but it's all the way back to where it was in December. And it's double what it was at the beginning of 2024. Gold is still at record levels. So I look at the gold price decline since February 28th, but especially over the last week, And I see various distinct things.
That crash in gold looks dramatic until you zoom out and realize it's still sitting near historic highs. As Jeffery Christian points out here, the February spike in the dollar wasn't a one-day war reaction. It was part of a sustained trend building since late January. A 20% drop from $5,500 to $4,100 sounds severe, but context matters. Prices remain roughly double early 2024 levels, which signals consolidation, not collapse. What investors often miss is timing. The sharpest drop came weeks after the geopolitical trigger, suggesting internal market dynamics at play. Next, Jeffery Christian unravels the real forces behind that delayed sell-off.
First off, the war was a couple weeks old. It hadn't lasted 5 days. It was going to continue. The second thing is that the FOMC met last week. And the FOMC meeting, I think, was perhaps more important to the decline in gold prices than the war, because the FOMC said, hey, inflationary pressures are much more persistent than the markets and we had thought. In late August, the Fed said, hey, we think that we may have to cut interest rates more than we had thought over the next year or two because of weak economic conditions. And that actually was the beginning of this sharp increase in gold prices from the end of August into the end of January. And then last week, the Fed came along and said, no, it's not going to happen. Inflation is much more virulent. Yes, we're worried about the state of the economy. We're worried about rising unemployment and low employment, new jobs figures. But inflation seems to be more of a problem right now. So we are not cutting interest rates now. And in the dot plot, we're showing you that we don't think interest rates have a scope to decline significantly through the rest of 2026 or 2027, depending on what happens with the war and depending on what happens with the potential of recessionary conditions, if not an outright recession.
The real driver of gold's drop wasn't war headlines. It was the Fed quietly pulling the rug on rate cut expectations. As Jeffery Christian points out here, the FOMC's shift last week signaled something critical. Inflation isn't under control, and easy money isn't coming back soon. That's a direct hit to gold, which rallied from August to January, largely on anticipated rate cuts. When the Fed's dot plot pushed expectations into 2026 to 2027, it forced a repricing across assets. Investors chasing the Fed pivot narrative are now facing reality. Next, Jeffery Christian talks about the overlooked forces accelerating this sell-off.
So I think that the Fed's actions and statements last week were more important in the sell-off. There are two other factors. One was just plain, simple, good old profit taking. You had a lot of people pour into gold from September into January. The price was moving sideways. It was kind of trending down toward the end of February. It's a good time to take profits. And perhaps the most important thing is that Dubai was closed by the war. And Dubai is the entrepot not just for the Islamic markets, from Morocco to Indonesia, it's also the entrepot for India and other South Asian nations. And there are flights every day from Mumbai to Dubai bringing in gold scrap to be refined. And there are flights from Dubai to Mumbai bringing refined gold to sell and silver. And that whole Dubai market has really been shut down by the airspace being shut down. So it's not that, in the Islamic world, throughout the Gulf region, the GCC countries, as well as Turkey and India, there were a lot of people who would like to have bought gold and silver over the last 3 weeks, 3.5 weeks now, but they simply can't get it because Dubai is shut. So I think it's a combination of those four factors that led to the gold price to decline. And I would point out, even though the gold price has declined, it's still at record levels.
The market didn't just sell gold, it temporarily broke the physical supply chain that supports real demand. As Jeffery Christian points out here, profit taking was expected after months of inflows, But the shutdown of Dubai adds a layer most investors completely ignore. This isn't just a trading story. It's logistics, a key hub connecting gold flows between the Middle East, India, and Asia suddenly went offline. That means suppressed physical demand, even if buyers are willing. When supply chains freeze, price signals get distorted. Next, Jeffery Christian discusses how these disruptions shape the longer-term outlook for gold.
So maybe give us a sense of which levels to look at next. I promised the audience you would give us your outlook. If we didn't buy in gold, did we miss this rally, Jeff?
I think you missed a short-term rally, but I think it still makes sense from a long-term basis. You know, the gold price can fall to $4,000, or it can fall to $3,800. It can actually fall even further and still be in a long upward trend. We think that the gold price probably will stay above $3,800, $4,000 in the near term, and that the price will probably consolidate with a slight upward bias over the next year, and move somewhat higher starting in the last 4 months of this year and going into 2027, and possibly going into 2028. From a long-term perspective, we think that the gold investment demand will stay at record levels. It was at record levels last year. We've never seen net investment demand of physical gold as high as it was last year. Our expectation is going to be even higher this year. We're looking at the potential that you could see the price consolidate for a few months, but given the political instabilities, both within the United States, within other countries, and on a global basis, that midsummer pause may not occur.
The real message here isn't about missing the rally. It's about understanding where the floor actually sits. As Jeffery Christian points out here, even a drop to $3,800 wouldn't break the long-term uptrend, which tells you how extended this cycle already is. That reframes recent volatility as consolidation, not collapse, especially with gold still trading near record levels after doubling since early 2024. But the overlooked factor is demand. Record physical investment flows suggest institutional conviction hasn't cracked yet. For investors, that means dips may reflect positioning resets, not structural weakness. Next, Jeffery Christian discusses what could drive the next leg higher.
Then you get into the final 4 months. You've got a very dangerous electoral situation in the United States that's going to get nastier, and that's going to cause more people to want to buy gold.
Your alma mater, Goldman Sachs, sees $5,400 this year. My question isn't really regarding their outlook. I just wanted to put it out there that other firms are equally bullish. However, I wanted to ask you, throughout your career doing this for many decades, has a narrative for holding and buying gold changed? In other words, were there certain periods of time when gold was more favored as an inflation hedge, a risk-off hedge, and I guess more recently a geopolitical risk premium hedge, or have these narratives more or less stayed consistent throughout the last couple of decades?
We have like 6 narratives, six reasons for investors to buy gold. And it's in our gold yearbook. We have a chart with, where we rate these things over time.
Wall Street is loudly bullish on gold, but quietly shifting the reasons why. And that's where the risk hides. As Jeffery Christian points out here, the narrative isn't fixed. It evolves with political cycles, especially heading into a volatile US election period in late 2026. Goldman projecting fifth up $400 sounds convincing, but price targets often follow sentiment, not lead it. The deeper question investors should ask is which narrative is actually driving flows right now? Inflation, geopolitics, or currency distrust? When narratives shift, positioning can unwind fast. Next, Jeffery Christian unravels how these narratives have changed across decades.
And you would see, for example, in the 1970s, that gold was really an inflation hedge. And it was also a portfolio diversifier because back then you didn't have You didn't have a lot of the derivative securities and investment. You didn't have ways to hedge your stock and bond portfolio other than gold and silver, right? So portfolio hedge was very important. Political risk has taken more emphasis really over the last 2 years or so. Uh, it's become perhaps more important than economic risks, but it has been gaining stature really for several decades. Currency risk is was greater in the 80s, but it's less important now uh, for a variety of reasons. So we have these six factors that are sets of factors that determine whether or not investors want to buy more or less gold. And yeah, the relative importance and significance varies over time depending on the economic and political environment.
I ask this because it's important to understand the core narrative now in order to make the assumption, in order to have the proper assumptions for forecasting is what I'm trying to say.
Gold's role hasn't changed, but the reason people buy it has quietly shifted beneath the surface. As Jeffery Christian points out here, in the 1970s it was inflation. In the 1980s, currency risk, and now political instability is taking center stage. That matters because investors often assume gold reacts the same way in every cycle, which is simply not true. When political risk dominates, price moves can become sharper and less tied to traditional indicators like CPI or interest rates. For portfolios, that means higher volatility even within a long-term uptrend. Next, Jeffery Christian talks about how today's narrative is evolving further.
Right.
So everywhere I go on mainstream channels and news, I read Goldman Sachs or JPMorgan, or it doesn't matter which shop, they're projecting higher gold prices on the back of stronger central bank demand or perhaps ongoing Iran conflict. And all these are assuming that the narrative for buying gold will remain constant throughout this year. But perhaps there's going to be a structural shift in how people perceive gold in the next year or two. But you don't think that's the case for now?
I think that you've been seeing a structural shift or a secular upward movement in investment demand for 26 years now, and that's going to continue in the long run. This year, politics are going to be very important, both on a global basis and on a domestic basis. So you have a lot of hostility within various nations. The United States obviously is very important, but you have a lot of dissension within various European countries and within various Asian countries. And the political risks, I think, are taking precedence over economic risks at this time. And that's probably going to continue through this year.
Everyone agrees gold is going higher, but almost no one agrees on why. And that contradiction matters. As Jeffery Christian points out here, analysts are leaning on central bank demand and geopolitical tensions, yet assuming the narrative won't shift, which is a dangerous assumption. A 26-year uptrend in investment demand sounds stable, but beneath that is a changing driver. Politics now outweighing economics. That creates a different kind of volatility, where headlines, not data, move markets faster. Investors relying on old playbooks may be blindsided. Next, Jeffery Christian discusses what this political dominance means for future price behavior.
Okay. What about silver, Jeff?
I like silver. It's much more volatile than gold. Gold's given up like 22% of its spike. Silver's given up 50% of its spike. But I do like silver. The silver market's relatively tight. One of the key things that we've seen over the last year or so, which we saw in 1979 and we saw in 2005, is that the gross sales of silver by investors has fallen off. In the late 1970s and in the early '80s, you had a lot of investors who were selling at the same time other investors were buying. And we saw that again in the period 2022, 2025. But since the middle of 2025, those investors who had silver that were selling have stopped selling. They've really pulled back from the market for a variety of reasons, but one of which is the price has been rising since the end of August. And it's like, okay, I want to sell my silver, I can finally recoup my losses that I've been sitting on for years. Some of these investors bought silver at the peak in 2011. Some of them bought in the peak at 2021. Um, they're saying, okay, I want to sell my silver. I can now sell it at a profit, but I look at the world, I look at the state of the world, and I look at the rate of increase in silver prices, and I think I'm going to wait before I sell because I just might get a higher price. And as long as that is the persistent view on the part of silver investors, they're going to refrain from selling and they're going to continue to buy. And
Remember a
that'll
few
keep the
years
price
ago,
high.
Remember a few
Yeah,
years ago when people were talking about how silver is used in munitions, Tomahawk missiles, for example, and it was critical in weapons
yeah.
and missiles. I mean, it still is. But if that narrative were important, then you should see silver skyrocketing because the U.S. burned through, what, $3.6 billion in munitions in the first 24 hours or something like that.
Right.
And,
I guess
and
you
people,
could take that as proof that that narrative was not accurate.
This isn't a supply shortage story. It's a psychology freeze hiding in plain sight. As Jeffery Christian points out here, silver's 50% drawdown versus gold's tuck with 20% shows how fragile speculative demand really is when momentum breaks. What's not being said is that investors refusing to sell creates artificial tightness, but that can unwind fast if prices stall near 2011 to 2021 break-even levels. The munitions narrative collapsing also exposes how easily retail flows chase headlines instead of real industrial demand data. For investors, this is less about scarcity and more about positioning risk. Next, Jeffery Christian unravels how gold's pattern may be misleading investors right now.
I think the concern from some investors in the gold space is not so much that it's still at record levels, is that the momentum seems to be still on the downward trajectory. And so if you look at how gold has behaved in prior bull cycles in 2011 and perhaps even 1980 as an example, gold is pretty much doing exactly what it was doing in 2011, double top, retracing by the order of double digits in a very short amount of time, then rebounding, and then the following year in 2012 and beyond was, as you know, underperformance. In other words, another 50% retracement from its highs. And so,
Well, the big sell-off was in April of 2013,
right.
when it fell from 1580 to 1280.
But does this look like the beginning of, let's say, the end of 2011 or 2012 to you, Jeff?
No, it doesn't. And the reason is I look at the reasons why investors have been buying gold and silver, and I think they're worse now. They haven't gotten better. If you look at 2011, 2012, there were people who sat there for their entire lives saying the Treasury is going to collapse, and the Treasury's interest rate assets are going to be downgraded. And in August of 2011, the Treasury's law was downgraded for the first time in its history. And that was at the same time that you had the sovereign debt problems in the southern tier of the Eurozone, especially focusing on Greece.
Gold looks stable on the surface, but the momentum underneath is quietly breaking down. As Jeffery Christian points out here, the 2011 style double top and sharp retracement pattern is already forming. Yet the key difference is investors today are reacting to worsening macro conditions, not resolving crises. What's often ignored is that 2011 had a clear event peak with the US downgrade and Eurozone panic, while today's risks, debt expansion, rates, and liquidity tightening are ongoing and unresolved into 2026. That changes how long capital stays defensive. For portfolios, this means volatility may persist longer than expected. Next, Jeffery Christian discusses why today's macro backdrop isn't triggering the same investor behavior as 2011.
So you had a lot of pressures there. And by September, the gold market said, wait a second, we've just had this cataclysmic thing that gold promoters have been telling us to be worried about for 40 years. The Treasury has been downgraded. And you know what happened? The demand for U.S. Treasury securities rose. So gold peaked in September of 2011. And the economy didn't collapse, and the world didn't collapse, and the dollar didn't collapse. In fact, the dollar started rising. Why? Because people were buying treasuries. Why? Because their interest rates went up because they'd been downgraded. So that was a completely different situation. Fast forward to today, that's not happening. Investors, despite what the gold bugs will tell you, investors are not dumping the dollar. Your chart shows that. The dollar is not rising because people are dumping the dollar in
Yeah,
treasuries,
that's right.
right? No one's dumping the dollar. People
Well,
look at the word. My
I
clients, who are mostly investors,
yeah.
institutional or high net worth individuals, are saying to us, hey, this is exactly what we've been expecting to happen
Hmm.
about this time. We don't want to sell our gold and silver and take profits. We want to keep our physical metal because we look at the world and it's not getting better, it's getting worse.
The biggest myth right now is that gold rises when the system breaks, but history tells a more complicated story. As Jeffery Christian points out here, in 2011, gold peaked precisely when fear peaked, yet capital rotated into US Treasuries, pushing the dollar higher instead of collapsing it. What's not being highlighted is that today's environment lacks that panic climax. Investors aren't fleeing the dollar, they're cautiously holding hedges while waiting for clearer signals into 2026. This creates a slower, grind-style market rather than a blow-off top. For investors, that means patience matters more than timing extremes. Next, Jeffery Christian shows how investor behavior today is shaping long-term positioning in metals.
So we've been doing a lot of hedging for investors over the last 18 months because they look at the world and they say, yeah, this is not where I'm going to sell. The people who were selling over the last month or so, or the last few weeks, have been shorter term momentum driven opportunistic investors who basically said, hey, the gold price has been rising, let's buy. And they bought into the ETFs and other gold assets. And now they're taking their profits because, hey, that move is over. If we're right and the price resumes its increase, they'll be back. But the real key is getting Dubai reopened.
What looks like selling pressure is actually a rotation between weak hands and strong capital. As Jeffery Christian points out here, the past 18 months of hedging shows institutions aren't exiting. They're managing risk while short-term ETF traders cycle in and out based on momentum. The hidden layer is that these fast money flows exaggerate pullbacks, creating false signals of trend reversals when long-term holders remain steady. The mention of Dubai also hints at liquidity channels and physical market access playing a bigger role than headlines admit. For investors, this is about understanding who's selling, not just price action.